Welcome to the daily update. This is being prepared Tuesday, October 18th, where we'll look at the action in the market today and then see how things look for Wednesday, October 19th. And we finally saw a couple of back-to-back up days. Now, are things improving? Yes, they are. We're starting to see some things turn more positive, but we're going to need to see follow through buying. So the picture is kind of switching a little bit. We're coming into that more favorable season now. Maybe we were able to establish a base to come up out of, but none of that's going to matter if we see some pretty intense selling coming back into the market. Now, if we go sideways, have a down day, maybe a down day that's less than 1%, just to give things a chance to catch up, that's one thing. But if we really reverse course and start heading down, that's going to take all the positive things that we're seeing pretty much and throw them out the window for the time being. But right now, it does look like we are improving. So let's go back and talk about what happened. Right at the open, we had a massive gap higher. We gapped to almost R3. We didn't quite get there, but R3 was at 37.71. We just got underneath that. We were into the 37.60s, and that was the high. Unfortunately, that was the high for the day. If you look at the bar, and I'll point that out as I go through this, it's not a really convincing looking bar. We were up, and there was some improvement with our charts, but the bar itself is a little scary looking right now. After we had that gap open, prices then retreated in an attempt to fill the gap, which is very common. If we have a gap lower open, we might see some buying coming in to try to fill the gap. Well, in Tuesday's session, we saw a gap higher, so prices came back down. They actually dropped below R2 at 37.20 and also down to R1 at 36.99. You could pretty much say 3,700 because that's kind of an important level. It's turned into one more technically, but it's also a psychological level. Plus, there's a lot of strike price options at that level. But we didn't get back down to the unchanged level. Sometimes that might act as a support level. We didn't get down that far. It was a pretty choppy day, actually. We chopped back above R2, only to come back down to R1 before closing back up at R2. Yeah. So we were up 1.14% on the day on above average volume. The technicals, yeah, they're improving, and I'll go through and show the charts and look at how things are shaping up that way. We're still really fixated on this idea of inflation and interest rates, and things seem, at least for the time being, to have calmed down again in the UK, but that could always come to the forefront. Things are still looking not very good between Russia, Ukraine. Of course, that's escalating, but is that going to eventually feed over into the markets? We're starting to get a lot of earnings reports coming out, and they can be real drivers when you have major companies coming out that can affect their industry group, their sector, and sometimes even a whole index. And then any Fed speak that we may get. So what are some comments that we can make? One thing that I did notice that's on a little bit more on the negative side, in Monday's session, growth and the NASDAQ led prices higher. On Tuesday, growth and the NASDAQ, as well as the NASDAQ 100, they underperformed value. Now, that's more of what we saw last Thursday in that really big run up, only to come right back down the next day. Now, we don't know if we're going to see that again. Just as I started recording, the futures are up about 0.5% in overnight trading. But as I always say, that's many hours before the market even opens, and a lot of things can happen between now and then. But this is just a little bit of a warning flag here to see that growth and the NASDAQ and NASDAQ 100 did underperform. Right at the open, the S&P was up as much as 2.3%, and we closed well off that high. That's what I'm talking about with kind of the scary bar that I'll show you. Goldman Sachs, Johnson & Johnson, they came out with their earnings, and they were better than expected. So that gave some support. The 10-year note settled at 4%. Now it's still below the 2-year yield, but just the 10-year note is kind of the benchmark. And that's what we compare when we're looking at different countries. That's what a lot of things are pegged to in the US and around the world. So the fact that the 10-year note was right at 4%, kind of a significant thing because we had been under that. The 10 to the 5, 10 to the 2, and I have the 10 to the 5 listed here twice. But the one that's kind of interesting now is the 10 to the 3 month, the one that we've been watching. It did go inverted. And the other one should be the 30 to the 5 year instead of the 10 to the 5 year. But that's kind of the last holdout. And that's what a lot of economists use to determine if we're going to be heading into a recession, where technically we already are in a recession. Some people think it's still coming and that things could get even worse than they are right now. But this one did finally go inverted. We'll see if it stays inverted. Sentiment is still fearful, but it's showing some improvement. We've had 2 up days now, so fear is abating a little bit, but we're still in that fear category. We had industrial production. It increased 0.4% on a month over month basis. That was better than expected at 0.1, which that's more kind of positive. That just means that industries are producing more than what they expected, which is kind of a healthier sign, not a real sign of economic weakness. And the capacity utilization, that's how much is out there that can be used. Is it all being used? Well, it came in at 80.3%, a little bit more than expected at 79.9. So this report was a little stronger than what they had expected. The NAHB housing index, it came in at 38. This was weaker than expected. They expected it to come in at 44. The last time we got this reading, it came in at 46. So this is suggesting the continued slowdown that we're seeing in real estate. Our trend is negative, and because of the 2 up days, the ADX is now starting to roll over. Hasn't quite gone below the moving average yet. It's still above 20, but it is really going down with the red line. We'll keep watching this to see, can the green line cross above that and have things turn more positive. I'm still keeping our bias at positive because we had Monday as an update. Tuesday was an update. I've switched our momentum to mixed because we had some really solid down days not all that long ago. We're kind of leaning more towards the positive side, but if we don't see follow through, we could switch back to negative pretty quickly. And we still need to see more confirmation that things are actually turning more positive, but they are improving. Then also, just to give you an update, every time the Phillies have won the World Series, this is our coincidental index. In 1929, 1930, 1980, 2008, well, in the first game of the American, actually, that should be National League, sorry, not ALCS, it should be NLCS. Philadelphia won the first game, so they're up 1-0. Now, whoever wins this will go to the World Series. So just kind of keeping an eye on that for some fun. Let's go back and talk about the day's session. We're more into the midpoint of the fear category at 34 right now. And we see over on the right-hand side how sentiment has been improving. This is also suggesting another sentiment indicator that sentiment continues to improve. We're still below this -1 standard deviation at -1.2. That's still fairly extreme negative, but not as extreme as it had been in the past. This is a longer term chart, and this is what a lot of folks use to decide on the really long-term trend of the market. And we call that secular bull or secular bear. If you use that as your definition, you're looking at this chart going, okay, we're still in a secular bull market. That's because the blue moving average, even though it's coming down, is still above the red moving average. And price continues, even though it's hanging out right around this 200-week moving average. And this is what I've been looking at. As long as we're above that, we're still in an overall uptrend. Other people, they use a different definition, and they may say we're in a bear market now, where we might be in a longer-term cyclical bull market, but for most of 2022, we've been in a cyclical bear market. So there can be different types of markets within longer range markets. But this is that moving average that we've been watching, and it's a little outdated now because we've been actually able to get above that. But this is that 200-week moving average. Very important support level. And so far, that has held up. Then another one, and I wanted to include a bit of a description here. This is the Philadelphia Fed and their state coincident index. Well, what in the world is a coincident index? A coincident index combines four state level indicators so you get one number together. And it takes non-farm payroll employment for the state, average hours worked in manufacturing by production workers, the unemployment rate, wage and salary disbursements deflated by the CPI, crams them all together and comes up with one number. Well, if we look down here, it says the number states it's been decreasing against the prior month. Recessions only occurred after there's been greater than 5 states that have seen at least 7 months of declines. So this is going up, but we're not necessarily at an extreme rate right now. This, if you go all the way over here, we're at about 12 to 13 or so. So actually, this could suggest that we could be getting close to this definition of a recession. But as this is going up, that just means that things are slowing down overall. Then systematic strategies. That's where you base everything around a system. You don't use any emotion. You just say, I'm going to do this, I'm going to do that. Well, when you position things, and there are investors who position themselves to buy low and sell high or go long, there's other investors who buy high and sell low with the idea of profiting when markets go down. Well, if you compare all of those, we're in a really net short positioning right now. And we have been ever since we hit that all-time high. It's been net short, but not necessarily at an extreme level. It's not down to where we hit back in the COVID low. But are we making some kind of a double bottom here with some of the improvements? If we see more follow through, will this chart start to turn back up? That's kind of what we're watching for right now. Another thing is these are financial management systems. I think that's what FMS means. They remain very bearish again on stocks, but there's no outflow capitulation yet. Well, we're kind of at a low level right down here with this dark blue line. And then inflows have not really dropped either. They're still above zero. That's what they're saying by the capitulation here. Well, we don't know if we'll see that. If we are finding a bounce right now, then this light blue line may stay above this particular level currently. Then here's our technical overbought, oversold composite, where we got down to a pretty extreme negative reading and we bounced up out of that. And that's kind of going more hand in hand with what we're seeing in our fear and greed index. Here, the S&P for the next 12 months, their operating margin, it has been declining overall. And that will ultimately feed through in the justification for stock prices being lower. Then earnings estimate uncertainty. They don't know what's going to happen next. This is the dispersion in the S&P 500 over the next 12 months, the EPS estimates. It just means uncertainty is growing. They don't really know what's going to happen. They're not as confident about things are going to be in the future. So to see this going up produces some concern in the markets. You could turn this around and look at it a different way, that the market likes to climb a wall of worry. And if it's worried about something like this, it could go higher. But it's ultimately earnings that drive stock prices. So if this is going up and EPS is coming down, that may put some pressure on stock prices. Here's another thing that these financial management services or systems, they are bearish in all regions. They're most bearish in the UK, and they're the least bearish in Japan. So over here, we have this really solid red line. They just don't like what they're seeing in the UK right now. The Eurozone's not far behind. US, it's negative, but they're seeing things a little more positive. Emerging markets, and then Japan, mainly because Japan's been going more sideways with their interest rates. They've got their own problems, and there may come a time when this red line for Japan is all the way over to the left, but it's not there right now. All right, the RIDEX bull bear ratio still having a tendency to pull ping pong a little bit with this after really spiking up when we saw that real down day on Friday. Well, after the big up day on Monday, folks have been starting to get out of the bearish funds and more into the bullish funds, and they were actually able to take advantage of Tuesday's advance. Now, if that continues, we will probably see this line drop. If it acts the way it was a week ago, they're just ping ponging in exactly the wrong direction at exactly the wrong time. So this is what I'm talking about, where value outperformed growth on the large cap, mid cap, and even the small caps. We were up, but to see value outperforming, that's a little bit of a concern. Growth is where we're going to get the real movement up in stock prices and in the S&P 500 by climbing higher. But hey, we'll take it right now if it means things are turning more positive. With the up day, the VIX is starting to come down after giving us a pretty extreme reading or a pretty high reading, meaning that fear was really high. As prices go back up, this is coming down. And the bar chart is also starting to come back down. And we closed just about at the low on the bar. The VIX of the VIX continues to fall as the VIX is falling, both with the bar chart and on the line chart. And we're starting to drop below the moving average here. So the VIX is settling down a little bit. Here's the daily chart of the Ulcer Index showing that fear is starting to subside a little bit. I'm still defaulting over to the weekly chart because this is more of what we're still seeing in our other sentiment indicators. That fear is still pretty high right now. We're down 22.8 since the all-time high in the S&P, so we're kind of inching our way back if we can continue to see some follow-through upside movement. Equity put call ratio continues to fall after giving us a pretty extreme reading on the daily chart. And we also hit that extreme on the 5-day chart where the equity put call ratio continues to fall. Here's the support and resistance levels for Wednesday sessions, which has already been posted on the YouTube channel, on the community tab, and then the other charts also been posted. And I'm trying to find a chart to show you how the bar looks, but I haven't seen one yet, where we came with the S&P right up to the pivot point. That acted as overhead resistance. That's just about where we stopped. And then we came back down, and volume did pick up a little bit. It's just slightly above the moving average. We're starting to regain some fib levels that we had lost. This is our longer term fib chart that we've been watching for quite a while now, where we got back above this level here, and that is also positive. We're still seeing, if we continue to move up higher, can we get up to this other longer term fib level? And remember that these are two Fibonacci levels right on top of each other. We're going from the COVID low to the all-time high, and then that low that we just saw back in 2021, that's also, this was another, it's another major low that was set. And these fib levels are on top of each other, so it's kind of like they're double strong right now. The weekly chart, we're still staying above not only the 50% retracement, but also above the 200-week moving average. Can we get back up to this 38.2% retracement level? That would be a lot more positive for the market. The trend channel still coming right back up. We're getting closer to the midpoint of our trend channel. Currently, the sectors, all of them were up, with industrials, materials, and utilities leading things higher, as well as financials, which have been doing better. The ones that were up the least were communication and healthcare. This chart that still looks the best is energy. It's got a score of 99.3, and that's the only one in the 90s, where we still have real estate in last place at single digits at 7.6. Here is over on the left showing how the energy sector is starting to make a bit of a comeback. Utilities have now gone into second place again. They had been in third place. Healthcare dropped back down to third place. And then how all of the other sectors have been negative, with communication in last place. Here's just an update of how the indexes have performed since the all-time high. It was the NASDAQ and NASDAQ 100 that were leading things lower. If we're going to turn around and really get some legs to go higher, we're going to need to see these percentages really decline, meaning they're going up, and see some real upward movement from the NASDAQ and the NASDAQ 100. Technical alerts, they were all positive, and some of them were internal, where we had the industrial sector had a BPI cross above 30, as did the financial sector, as did the communications. Well, it went above 20. The S&P went above 30, and I'll show you a chart there. The NYSE BPI went above 30. Materials sector and cyclicals, with the materials going above 20 and the cyclicals above 50. So we're seeing some internal strength coming back into the market right now. And then the S&P was able to get back above 3,700. The Dow is now in first place at 71.3. So this is showing some improvement. In second place are the mid caps, which held up better as we were going down. They're at 68.8. And small caps are in third place at 65.4. We're still not seeing a lot of follow through on the technical side with the S&P yet. It's at 45.1. And the Qs, although they're improving, they're in last place at 20.5. Here's our intraday chart. And this is where we spiked up right at the open. And we set the high at the open. And we never did get back to that level for the rest of the day. We really gapped above R1, R2. We didn't quite make it up to R3, which is what I had to add this on the chart. And then we spent some time coming back down through R2. We actually fell below R1, never came down to the unchanged level, saw some bouncing coming back up, got a little bit above R2, then back down to R1, and then closed back up at R2. So it was kind of one of those roller coaster days overall. Our trend, maybe this will help show you. You see over, this is the bar for Tuesday's session. The wick to the left, that's the open. And then the wick on the right, that's the close. So although it's an up day and some improvement happened, it's a little bit concerning when we close well off of the high for the day. We were just about in the midpoint, but at least it was an up day. Now, if you look at the ADX, it's starting to roll over. Another day or so of this, and it could go below the moving average. We're seeing the red line decline, and the green line is finally starting to advance. Once these two cross, if that happens, this is when we will change over to a positive trend. We're seeing a little bit of improvement with our Arun as the oscillator starts to turn back up ever so slightly after giving us an extreme negative reading. Our breadth, showing some improvement based on price and volume, but we need to see more follow through with that. The advanced decline ratio also is showing some improvement. New highs, new lows. We're not really seeing any breakout in either direction right now because we're in this mess of prices where we have been not very long ago. If we can break above this, then you're going to see a real expansion of the new highs. If somehow we start going back down, then you're going to see a real expansion of the new lows. But the 5-period moving average, it's trying to stay going up. And we're seeing kind of flat still with the 10-period moving average. The accumulation distribution, this is a little bit concerning. We had an up day, but it declined and is still below a declining moving average. Short term, they actually had a bit of a change in the decision point scorecard. In the short term, their PMO has switched over to positive, and we've switched to positive with the PMO also, and I'll show you that. We were able to clear back above the 20-period moving average and close above that. Not very much, but we still closed above it anyway. That is positive. Now, can we go back and get to the 50? Can we get back to the 100? Can we even possibly at some point get back to the 200? Now, this can act as overhead resistance as we're bumping up into those moving averages, but just to regain this right now is pretty positive. The rate of change going back 5 periods, because we had some really down days, we're starting to get a little extreme negative, or excuse me, extreme positive, but this still could go higher. The Stochc RSI is already in extreme positive territory, but it can stay up here for a long time. This is a very touchy indicator. Our Williams percent R, which is also pretty touchy, it's acting a little more sane right now. It's showing that things are more positive. The force index is also turning more positive. The Swinland trading oscillator based on price and volume have crossed above the zero lines there, and they continue to be going up. So that is positive. McClellan oscillator positive, could be getting close to an extreme positive reading, but it could go higher than where it's at. We're seeing a lot of improvement with the 20, 50, and 200-day moving averages. They are starting to look more positive. The stochastic short term, more positive. Intermediate term positive and trying to turn up and come out of being an extreme negative, but looking more positive is the long-term stochastic. Intermediate term, we go back with the rate of change 50 periods. We're trying to come out of this extreme negative reading. Sean trend meter showing improvement. Here's the PMO. We crossed over positive, and we crossed over based on price and volume. So this is a confirmation of a positive signal. The PMO study looking a little bit toppy right now, but could go higher, could bounce a little bit, even drop and not really do a lot of damage with those PMOs that are rising. The buy signals are positive, and we're trying to turn up a little bit with those PMOs that are above zero. Chaikin oscillators, still negative. We're below the zero line here, but showing some improvement. Chaikin money flow, though, this still is going down. It doesn't like that we opened here and closed down here. So it's not really liking the price action that it saw within the bar. So it's still more negative. Volume still is continuing to trail off on average overall. This is another positive sign in the vortex. The green has now crossed above the red. So now this is positive. Summation index has turned up based on price and volume. So that is more positive. And I think all of our oscillators, the slope is positive, the MACD is back positive, the KST is positive. We're a little bit flat with the tricks. The PMO is positive, and the TSI has now switched to positive. So with the exception of the tricks, which is still kind of going sideways here, our oscillators are now back to being positive. And here's where we crossed above that 30 line with the BPI. We need to see more strength going up if price continues to go up. And the ease of movement is showing it's more positive now. So it's showing improvement. Ultimate oscillator above the midpoint here, that is positive. Money flow index also just barely above 50. So it's turning more positive, even though it was a little bit flat on the day. The TTM squeeze is looking more positive. It's really messed up. That's why you see this little red dot here. But things are turning more positive. And we'll just have to see how this plays out. This has really been whipsawed lately, as has the CMB model, which I'll show you here. This is also kind of interesting. It didn't like how we opened high and closed much lower on the bar, so the balance of power actually declined. This is the CMB composite that I was talking about, where it's just been giving us all kind of signals. Well, now it's back to you might be able to confirm this as a buy signal because it barely crossed above the green and then it crossed above the red. So that's looking more positive currently. We're looking more positive with the Heikin Ashi. In fact, we are positive with this. We're still negative with the Kegi, even though the red line is going up. It needs to turn back to black to be positive. The Renko is redrawing a little bit, hasn't switched over to more positive, but it has redrawn to put that open box in there. Three-line break is looking more positive. And we added another X with the point and figure chart, but there's been no signal generated as of yet. We're back to positive with the Elder Impulse based on the S&P and the SPY. This is another big one. At least I think this is a big one. See, the dot is now below. The SAR has switched back to positive. We're in neutral territory with the go, no-go system with the pale purple. Longer term, we're showing a lot of improvement with our 50, 150, and 200-day moving average studies here. Rate of change, trying to turn up when looking back over 200 periods. Special K, trying to turn back up, but still a long ways away from the moving average. Looking at some other markets, we are positive again with the diamonds. If we get up to this 65-period moving average, will that act as resistance? We broke above the pivot with the Dow, and this is also where the high was on the left and the low was on the right for the close, but still it was an up day overall. The Qs have switched back to being positive, and they still have a ways to go to get back up to this pivot level. The Vixen is dropping because the Qs are going up. The NASDAQ still has a ways to go to get up to the pivot level. We're going to need to see this on the NASDAQ 100 really kick into gear if growth is going to start to lead us higher. The mid caps, this is almost a doji type of a look where the open and the close are very close to each other, but we're still above this pivot point. The Wilshire still has yet to come and reclaim the pivot level. Dow theory showing how the Dow's been bouncing up and the trannies have been bouncing up. Utilities have also been showing some improvement. And the dollar, it was actually up a little bit. And I was watching that. And maybe that's why value outperformed growth. Because even when we were really sky high at the open, the dollar was still up. It was down for a little while, but then it came right back up. So for us to really get some legs behind this, the dollar needs to give some of the gains back. And we don't know if it's ready to do that yet. The S&P to the dollar, they're still having a pretty strong tendency to go in opposite directions. Gold, even though it was up almost 0.25%, continues to be in a downtrend, as does silver. It was up 0.64%. Oil dropped down to 82.07. As we get closer and closer to the election, they're going to do what they can to try to lower oil prices and gas prices, because that's what we see all the time when we're out and about and everybody talks about it. And if gas prices are going up, you have more of a tendency not to vote for who's in office and possibly vote for somebody new. The S&P to the oil, still neutral right now. And then looking at bonds, we were up about 0.25% with our bond ETF. We were up 0.33% with our world bond index. And here's our yield curve showing the 10 to the 5 is inverted. 30 to the 5, which I messed up on the slide there, is inverted. 10 to the 2, this is all the same, but this is the new one. We're not inverted by very much. It's 0.03, minus 0.03, but we have gone inverted with this one. 10-year treasury yield after coming up to 4%. Actually, we said it closed at 4, but this actually settled a little bit below that. The 30-year is above 4% right now, but we still have the 2-year in the lead. It's giving the best return, and we're seeing a lot of jockeying around, a little bit of crossing between the 3-month and some of these other points right now. And that's why we're seeing such a crazy yield curve right now. Stocks and bonds, they're having a little bit of a tendency to go in opposite directions, but it's still a pretty strong positive correlation, even though it's starting to weaken. 10 to the 2, the S&P to the 2-year also is not a real strong inverse relationship, but it's still in that tendency. The S&P to the 10-year, again, weakening a little bit here, but having a tendency to go in opposite directions. Tech to the 10-year, also, this is a little stronger with going in opposite directions. Our scenarios, just to give you an update, we're seeing a lot of improvement on this chart, the 19-day exponential moving average of the advanced decline ratio. It is starting to bounce back up after giving us a spike extreme negative warning, both based on price and volume. So this chart is improving. We're seeing a little bit of improvement with those stocks above their 200-day moving average. This is where we're seeing a little bit bigger move, because this is a 50-period moving average. After giving us that extreme negative spike, it's showing some improvement. Can it get some legs and keep going? Or are we going to stall out and come down and set another potential signal? Looking at some improvement with the mid caps and with the small caps. The 10-day average of the S&P high minus the lows, this hasn't changed. With the highs, lows so flat right now, we're just not reading anything new into that until we see an expansion of price to go higher, to set some new highs. And then looking at the broad market, not really changing all that much. We're still negative overall with the highs minus the lows. This is more to the internal side of the market. We want to see this really start to go up after giving this extreme negative reading, if that is going to help give some support to the S&P. This is also continuing to decline. Our 5-period simple moving average of the equity put call ratio, we're still working off of the spike, and it's coming down, although not very much right now. The small caps also looking a little doji-ish here with your candlestick name, but we were up over 1% with the small caps, but that bar is a little bit scary right now. And the small caps did slightly outperform the S&P, and so we're seeing a little spike up on the red chart, which could give some more support to the blue chart, which is the S&P. Not really seeing a lot of improvement with our sector rotation. The Qs continue to fall. Discretionary, it is a little bit flat. Large cap growth to large cap value, a little bit. We want to see these come and get back above the moving average and really start to move higher. And then looking at the large, mid, and small caps, again, showing some improvement here, but still below the moving averages. This is still helping us out a little bit, even though the ratio was down slightly. We're seeing the S&P continue to outperform the utilities, the S&P to utilities ratio, which could give some support to the S&P 500. Then the spike, well, we don't know. I mean, this 2-year just keeps going up and up and up and up and up. So we can't really call it a spike until it actually starts coming down. The staples were up 1.3%, even though they're in an overall downtrend. And so it's still looking like this latest spike is holding up for the time being, which again could give some support to prices for the S&P. Copic curve, we're still working off of this signal. We want to, if we're going to, something's going to happen. It'd be nice if it happened sooner rather than later, because the more days we leave behind after this generated a signal, kind of the less influential this signal is. Where our Pring bottom fisher, kind of the same thing, even though it is improving, we want price to really start to pick up this signal and go higher if that's what's going to happen. So what's our outlook for Wednesday? The technicals, they're turning positive. They're pretty much positive in the short term. We still have some shifting to do in the intermediate term, and they're still negative in the long term. But we need to see more follow-through buying. Are they going to sell into strength? Have we seen 2 good up days only to give it all back on Wednesday? Or are we going to see some more buying on Wednesday? It doesn't have to be all that powerful. The bar that we're seeing right there is a little bit concerning. Can we have some follow-through price action that takes the concern of that bar away? We have the weekly MBA mortgage applications index coming out, and there's some real estate information coming out. Here's housing starts, building permits, which serve as a leading indicator. And then the whole list here, Ukraine, Russia, that whole thing. UK seems to be behaving for right now. Inflation and interest rates are the real concern for the markets. Any Fed speak that we might get. So I'm kind of going with a dual scenario right now. You could still say we're down because intermediate term and longer term, we're still negative, but the technicals are turning positive. So that could make you a little leery of going with the down scenario. We could go with the up scenario because short term we're turning more positive, but we have to see some follow through and then some more improvement with our setups, our rotation, and our scenarios. The technicals are looking better. We regained the 20-period moving averages. Can we stay above those? Can we regain some pivot levels and some fib retracement levels or any previous support or resistance levels? And then we're not really sideways, even though the ADX is weakening. Now, if we drop below that moving average, I might change that, but it's still above 20 overall. And the red line is still on top, so it's negative. So our conclusion, the S&P is turning positive, but we got to see follow through buying right now. Doesn't have to be big. And even if we see a down day, as long as it's not too severe, this positive side may be able to hold up. But short term, we're back to pretty much positive right now. Intermediate term, it's still looking better, but has a ways to go. But we're still negative in the long term. So thank you very much and have a really wonderful day. And I will look to talk to you after Wednesday's session.